Hello, I am Mir alias Gary, Regional Vice President with the CCIM Institute for Region 12 and the CEO of Creeland Consultants Realty. Welcome to today's webinar, Surfing Economic Shockwaves in Region 12. We're happy to share this webinar with everyone in an industry. For CCIM Institute members, this is just one of many member benefits that are designed to help you adapt and thrive in 2022 and beyond. Joining us today is CCIM Institute Chief Economist Casey Conway. He's going to share an in-depth look at the many factors affecting the economic tides, what to look for on the horizon, and how to ride the wave of opportunities in our region. Please feel free to ask questions throughout using the question and answer tab. We'll be answering as many as we can at the end of discussions. And if you're experiencing any technical difficulties, please use the chat feature to ask for help with that. The recording and the accompanying presentation will be emailed to all registered attendees. Casey, welcome and thanks for joining us today. I'll turn over the show over to you.
Great. So you got my audio, but it's saying the host will not allow me to take over. So maybe our host needs to allow me to take over. It's not letting me access my video or the slides. There we go. All right, perfect. Always a little fun on these things, right?
Knowledge always is, but we're doing good. We can see you live perfectly.
All right, so it just went away again on me. So let's see what's going on here. I'll expand this. All right. Give me just a second here. All right, I will start, see if the screen will let me take over now. There we go. Looks like it's letting me. In 1 second here. Still feels like Monday. How about that?
Everything looks good, Casey, on our end. We can see your slideshow and you can hear you perfectly fine.
There we go. Here we go. We got a big screen. All right, appreciate it. So great to be with Region 12 in Canada. I enjoyed my time when I was Collier's chief economist. I didn't enjoy the 9-hour flights to Vancouver, but I enjoyed Vancouver and Toronto and Montreal. And one of my favorite shows when I'm really tired late at night is Highway Through Hell and watching the trucks and towing them in the wintertime that crack up on your busy logistics highway system. So great to be with you guys all. And somebody be watching for the Fed decision. I'm guaranteeing it's a 75 basis point increase. So I think it's right now we're 230. So if somebody's got that, let us know. All right, so here's obviously we know where Region 12 is. You're off the charts there. You're on America's fourth coast. Beverly and I, we talk about it all the time. America thinks there's just 3 coasts. There's really 4, the Great Lakes, and how important that Great Lakes fourth coast is to Canada to make our economy work, whether it's, potash or lumber or rare earth minerals or, energy or whatnot. We forget and take for granted how important our Canadian neighbors are to us. Here's my normal disclaimer slide to protect you and your region and all of you guys. So it's all me. Beverly's got the square. If I say anything bad, we've got $100 left in the account today. So we'll let you swipe and take the $100. All right, I'm going to start where I normally end, and that is to give you kind of my top 10 items and thinking, rather than making you wait to the very end. So here's the top 10s I think we all need to be monitoring going into the end of the year here. So obviously today is Federal Reserve, their next to last meeting, and the inflation numbers, the JOLTS numbers, everything is just showing they've got to keep their foot on the accelerator for rate hikes to stop inflation. We're over 7% on the mortgage money, 10-year treasuries over 4, the 2 years over 4.5%. The Fed wants to see pain. They want to see unemployment. They want to undo their other mandate, which is full employment, to basically prove that they've tamed inflation. So if we're going to have, one of their 2 mandates out of whack, I'd rather have everybody employed and getting raises and working than have a little bit of inflation or zero inflation and this being a 1970s thing. So anyway, these are the 2 key dates. And then we need to keep an eye on the inflation metrics. And we'll look at Canada's relative to ours. You guys are running a little bit less in the 7% range, where we're running 8.5% plus. But we look at, or I tend to look at, more importantly, the PPI, the producer price index, because that's the inflation that's going into all the input items. And that eventually flows into CPI and everything else. So I monitor PPI because it tells me what's going to happen next with CPI. Our most recent numbers, both were double expectations, 0.4%. So we're still running pretty hot on inflation. My other one I'll talk about is the flexible CPI. You guys may not have heard about this one, but this is produced by the St. Louis Fed. My friend Jim Bullard, who's president of St. Louis Fed, they've been producing these back to the 1970s. They strip out and look at those things that are repricing every 90 days. And it's more than food and energy. They also look at shelter. This summer, we broke all-time records going back to the 1970s and 80s at 25%. That meant the real household inflation for things that are repricing every 90 days was 25% in June of this year. Earnings. So we're midway through the earnings season. We haven't got to the retailers yet. We've had a mixed bag. Some of the banks were doing okay. But one of the things we're noticing in the banks are two things. Investment banking activity in Wall Street is slowing down. People are uncertain whether they really want to move forward with a lot of investment banking. The second thing is when you have a 4.5% 2-year treasury, a lot of deposits leave the banks. And so that's the thing that we're seeing is, because of these higher yield rates, deposits are leaving when banks are only paying you 1% or less on your deposits. So it's something the banks need to be paying attention to. They keep saying, well, we're going to have lots of good net interest margin, but they're forgetting what's happening to deposits right now in this type of inflationary environment because they haven't had to deal with it for 4 decades. So anyway, watch that one. The other thing the banks are having to do is they're having to add to what's called the ALLL, the allowance for loan losses and lease losses. And so that's the other side of the net interest margin. So they make money, a lot of money on your deposits, but they forget to take into account the credit losses. And the regulators are telling them they need to start building up their capital again for credit losses, the ALLL. The confidence measures, a lot of this that goes on in the economy and inflation, everything else is psychological. And so it occurs at 3 levels: the consumer, the small business, and obviously in housing. So the consumer, the University of Michigan, we broke all-time records this summer on how bad consumer confidence went, obviously with inflation. Small business, the same thing. And then housing. In the States, we're in a full-out housing recession. When you take mortgage rates from 3.5 to 7, when you take home prices in a 2-year period and have them increase 50% plus, and you have the average mortgage payment go from $1,500 to $2,500, you shut down housing. So we're in a real bad shape here. The supply chain measures. So we forget, you guys don't, how important supply chain is because you're supplying us with a lot of stuff in the rest of the world, whether it's rare earth minerals or potash or lumber or many of the other things that, come down through the Great Lakes or through the Canadian Pacific and Canadian National Rails. So we'll look at those. The CPPI measures, that's the commercial property price indices. So Green Street does one that's more investor institutional assets. And then CoStar and Real Capital Analytics have a broader one. All of them have peaked out and they're all starting to trend down. And it's without the cap rate change yet. So we'll talk about, there's 2 elements that are happening that are stressing commercial real estate prices. The first is that expenses are growing faster than rents. And when you have that happen, you have a hit to NOI. And that's most of what we've seen correcting prices right now is expenses growing at 3 times rent growth. And so the NOI is obviously going down. That's about a 10 to 15% hit on values. What comes later is when you do your band of investment and look at what should happen to the cap rate. And we'll share a good example from a fellow CCIM here. And then put a neat template out there for all of us. And if you look at what potentially happens when you go from a, 3% or less 10-year treasury, 2.5, 3% 10-year treasury to now, which probably the Fed's going to take us to 5. That impact on cap rates when you do your band of investment between debt and equity results in about a 20 to 25% hit to value. So you put the 10 to 15 and you put the 20 to 25 together, and that's how we get a 40% hit to value that everybody's worried about. The other thing I track a lot is encourage everybody to look at the VIX. That's the volatility index. And so it's really a broader measure of the total market telling us how freaked out they are. And so when the VIX gets above 30, the market's in freak out mode. We've been in above 30. We've got as high as in the 50 to 75 range during COVID, and also back to the Great Recession in 2009 and 10. Let's hope we don't go back there. But until you see that VIX come back below 30, expect a lot of volatility, expect a lot of losses in the stock market. So I look at this, and this will flow through all the asset classes. The misery index. So we kind of forget about this, but it was created by Steve Forbes back in the 1970s. Ask Jimmy Carter about it, and he may have a stroke, but it was kind of one of the things that defined his administration. And what they did is they really, back in the 1970s, 80s, they just added inflation to unemployment. And that number got up to almost 13% at its peak. Well, they've modernized it. So Forbes has modernized this, and they said, look, in the 70s, not many households owned stock. So we need to put the S&P 500, and we always should have had GDP. So with GDP negative, forget the phony number that just came out, we will be negative for the year. The S&P 500 down over 15, headed to minus 20 to 25% for the year. We're at something like a 20 to 25%, 20 to 25 number on the misery index today compared to 13 back then. So, and if you look at the UK and you look at Europe, their misery index is even worse than ours. So I guess we're just, misery loves company. We're joining everybody around the world. The CREPI, this is a neat tool for us as CCIMs. We introduced this with CCIM Tech last October in Pittsburgh. I now write a monthly piece where the CREPI is being released now monthly rather than quarterly, thanks to CCIM Tech and Stan Gronkowski and Mark Seipert. And so we hit an all-time low, a record low of 82 in the July numbers in the latest August, September numbers. So it came back up a little bit to 83, but that's well below the all-time low back in 2009 of 84. So this has been back tested back all the way to the beginning of 2000. And we're seeing this come down, and we'll share with you a lot of details about CREPI coming forward here. The next one is we have a little event here that you might have heard about. Hopefully you're not getting all the political ads, but a week from today, we have our November elections. And it's going to have a watershed event here. It's very important. A couple of things without being political. But one of them is the future of energy. So we have a current administration that wants the rest of the world to produce more energy for the US, and us to say we're not producing it because we're being green. I think it's very disingenuous, but between Canada and US, we are the Saudi Arabia of natural gas, and the rest of the world and China and Russia don't like us very much. I think we need to get back to our energy independence. What happens with the November elections will really dictate where both of us, you on the Canadian side and you on the US side, have things occur in the industry, move forward in energy. So that's one. If you're wanting my estimate on where things are headed, I think the Republicans will clearly take back the House. The question is in the Senate. And I think the polling is terrible, so don't believe any of the polling numbers. In the Senate, it's going to really come down to 3 states. If you want to stay up late and you want to know where to focus on the results, it's going to be Pennsylvania, with Dr. Oz running on the Republican side, in Georgia, Herschel Walker, in Arizona. If the Republicans don't take those 3 seats, they will not regain the Senate. So those are the 3 that are really going to dictate what's going to happen there. So there's my top 10 about what we're going to be looking at. You don't have to wait for the rest. We'll just peel these apart like an onion. So let's look and go right into the CCIM Tech's CREPI. So you can see the chart there. We're in March of 2009. The CREPI hit its lowest when we back tested it to 884. And you can see where we've fallen from September of last year when we were in Pittsburgh, October. And we were still in the 90, almost 92 range. We fell down a little bit in January. But remember, a lot of these data metrics are a little bit lagged on the data. And the Fed had not started to move interest rates until March. So in that first quarter, we really didn't see the impact of interest rate hikes until really we got into the second quarter here. And that's why you see this steep decline from first quarter down into the summer here of 82 and 83. On the left are the 10 metrics that we said, look at, can we find 10 windshield indicators looking out the front that'll really tell us what's going on in the economy and real estate. So CCIM Tech and myself and Beverly, we all work together. And these are the ones, and we're going to talk about these, like the University of Michigan Consumer Confidence, all the confidence measures I just talked about, the jobs numbers, the JOLTS in particular. And just yesterday or last Thursday, we had a big increase in the in the JOLTS numbers, it reversed from where we had a record number decline of over 1 million, and then continuous claims didn't fall down like we thought they would. The Green Street CPI numbers. So you can see those 10 metrics. And if you go to site2dobusiness.com/CREPI, you'll be able to access everything in there, the whole Excel workbook with the numbers and the historical numbers on all of these 10 metrics. And then if you click on the About CREPI or CREPI Explained, that opens up the narrative that I now write. So that's where you can get this. This is free. You get to access it for free. Your clients, you can forward this. It's really a value add tool. I keep trying to get the Fed to use it. I brief them still quarterly, the bank regulators. I'll be in Boston tomorrow for 3 days with bank regulators and appraisal foundation. And we'll keep trying to get this into the FOMC, but this is a tremendous tool. Hopefully we'll see it start to now occur, like maybe in the Sire magazine. And so it'll even get broader visibility. But I think this is one of the best tools that I looked at, not just because I was involved with it, but we really put a lot of work into this. I tip my hat to the CCIM Institute leadership and the CCIM tech folks for making this happen. So take advantage of this and send it to your clients. It's a way to engage with them. All right, we'll talk a little bit about inflation. Some of you have heard me talk, some of you haven't. Might be new audience here, but I produced this slide here, number 6, over a year ago. And as we went into the fourth quarter last year, I really feared we were headed back to a 1970s, 1980s type event, inflation and economy. And people thought I was crazy, and I will confirm, Beverly will confirm it too, and probably Larry, Ollie, that I am crazy, but sometimes I'm right. So the blue line is inflation. The shaded areas are the big recessions around hyperinflation. And there's 3 things that led me to this chart and this conclusion that we were headed to 1970s, 1980s. Only Jim Bullard of the St. Louis Fed and myself were in this camp and were proven right. But here's the 3 things. Before every hyperinflation period in recession, what we have is a period of deficit spending, massive deficit spending. So preceding the 1970s, the deficit spending we had in the 60s was for the Vietnam War. And then today, it's all this deficit spending around COVID. And then we were on an addict diet of deficit spending before COVID, but we just decided to put the calories on then. The second thing that happens is you have a very disruptive, unexpected black swan market event. In the 70s, that was the oil Arab embargo. And so that was a very serious situation. We didn't understand how much energy was embedded in our GDP, how inefficient we were. You know, we built cars that were 70 feet in length with no cup holders, and we later had to learn how to build a 7-foot car that had 70 cup holders. The Japanese helped us do that. And then the third thing and the equivalent of that today is a supply chain shock. And we could have an energy one on top of the supply chain, because the energy is not just a supply chain. It's basically the US saying, we're not going to use, we're energy independent. We can do LNG gas as a transition, but we're not going to do it. But we'll tell OPEC to produce more energy. We'll go to Venezuela. We'll go to people that hate us and that have worse energy and oil product, and ask them to produce more. So it's kind of disingenuous when you're saying we're all trying to be green, but we're saying if all of you will produce, but we won't, then we'll be green together when we're still consuming more. That doesn't make any sense. So the third thing that happens is when you get to the bottom of these inflation and recession cycles, you have a politician that comes up with a crazy idea that really just throws like gasoline on the fire. In the 70s, that was Richard Nixon's idea of price controls. So he said, okay, I'll put price controls in effect, ta-da, inflation's done. Ask Jimmy Carter how that worked out when they had to take off the price controls. The equivalent to that today for us in the US, and really if you look what it's doing around the world with our strong dollar against the UK and everything else around the world, is the Fed and the Fed's balance sheet. So the Fed is really one of the biggest currency manipulators in the world. We probably manipulate currency more than the Chinese, to be honest with you. And I spent 5 years in there watching it firsthand. But what the Fed's doing with its balance sheet, it took it from when I was there, 2005 to 10, from around $1 trillion to $4.5 trillion in 2008 and 9, and then to over $9 trillion during COVID. And it's just a little bit below that. Then Congress threw in another $12 trillion. You can't throw that kind of money into the economy and not expect to get hyperinflation. And that's what we're doing. That's what's happening today. And no one thought through, how do we unengineer this without destroying the economy? So that's really where we are. That's where I kind of saw things last year, as did Jim Bullard. And now we're dealing with the reality. All right, so let's look at Canada's inflation. So you've seen it rise quite a bit. You're in the 7% range, and we're at the 8.5%. But you'll see it's really absolutely a lot worse than that. So all of us are in this inflation nightmare, and where does it end? And I don't see the end in sight. And the ones I'm most worried about, one is energy, two is food inflation. The war between Russia and Ukraine took 1/3 of our grain and wheat offline in the world, and now Russia's pulling back and letting Ukraine continue to export what they harvested. So it's going to get worse. And then in the U.S. and in Europe, we're both in severe droughts. And so between the two of us, we represent another 40+% of the grains and agricultural products of the world. And those are basically being cut in half. So the world, as we go into the winter months, is going to see somewhere between 30 and 50% less grains and less products. And that's just going to create a lot of food inflation. The metric I'll give you guys to keep me honest on is look at what happens to the price of a loaf of bread. So in the US right now, it's below $3 a loaf. My forecast, and we've seen gas right now around $3.50 a gallon. I just filled up yesterday here in Georgia. And my forecast is that we will see a loaf of bread by the Christmas holidays be more expensive than a gallon of gasoline. And I think we're going back to $5 a gallon gasoline. And you'll see when I talk about the strategic petroleum reserves and that manipulation, why I feel that. So look and check and see what happens to a loaf of bread. All that stuffing and all those, biscuits and everything else that go into your holiday meals are going to be a whole lot more expensive. All right. But something happened this summer that some of you are pretty sharp on the call here. You may have noticed that our CPI went flat in July. Well, Casey, what the heck happened? What happened is in this winter and spring of this year, we did not tap the Strategic Petroleum Reserve. And by the summer, the administration said we're going to release 180 million barrels of oil from that. And we're going to bring the price of energy and gas and diesel down. And that's what they did. And so they basically took energy inflation out of the equation. And so it muted what was happening in wages and food inflation. That all unwinds here pretty much the next month or so, because the Strategic Petroleum Reserve can only be depleted so far. It's not a well, it's not a reserve. It's, or it's really a reserve. It's not meant to be a pipeline flow. And so we have to stop that. We also had states suspend their state gas taxes, and they've got to put those back in place here at the end of the year, going into next year, to fund the committed road and infrastructure projects. So we put energy back in there, and we're off to the races of looking at like 10 to 12% inflation. So that's what happened this summer that's going to unwind here. And that's why all this discussion about a soft landing and inflation peaking, I was just given my annual barbecue sauce award. For those of you who don't know, my barbecue sauce award, that's the polite way of saying BS on something. So I grew up in Colorado, 40 years in the South. I had to figure out how to politely say BS. And so we call it barbecue sauce. All right, this slide 9 is important because it really looks at segmenting what we've been through really almost the last 4+ years into 3 kind of segments. So the pre-COVID era, as we know, was 2018-19. Look, we had normal 2.5 to 3% GDP. And then look what happened. 2020, we went minus almost 3.5. Then we went positive 5.7 GDP last year. This is when last year we should have been like what we're feeling this year. But when you throw all that money in place, you overstimulate things. And now we're running, pretty much below 1% GDP. If you look at the first 2 quarters of negative and the plus 2.6% here in the third quarter, which again, I'll explain, that was largely influenced by 2 things. The Strategic Petroleum Reserves were counted as like exports. It was pulling it out of the ground, pulling it out of the government and releasing it into the private sector. It's like we produced all this energy. Nobody was connecting that dot, including me. The second was a huge spike in defense spending to help Ukraine. So none of us had really thought how big, or we didn't have the transparency to see what was going on in defense spending. You throw those 2 things in. And then the last thing is, because of the strong dollar, everybody in the States and probably you guys as well in North America said, let's go visit Europe. It's on sale. And so those 3 things factored in, and those 3 things all unwind here in the latter half of the year going into next year. The dollar may stay strong, but because of inflation and the recession, I don't think we're going to be traveling to Europe. The Strategic Petroleum Reserve stops and all that benefit. And then who knows what goes on with Ukraine and what we're going to fund there. Then we had the COVID era, and you can see what happened there. We had a very nice below 2% to 2 3/4% 10-year Treasury. We're now, over 4%, headed to 5% after this rate hike and the one in December. And then you can see what happened as well on the CREPI. We went from 96 to 99 into a record low of 82, our steepest drop in history. So we really had a whiplash. And what I want to emphasize is we are not in a post-COVID environment. In North America, we're fortunate, particularly in the US, that we have an effective vaccine. We got over 80% of our population vaccinated, but that's not the case with the rest of the world. If you look at Africa, you look at China, China's 40% shut down. It's 45 biggest cities that do manufacturing and everything else are all idled. And so China's locked down. They don't have an effective vaccination. Parts of Europe do and other parts don't. So we're kind of in a unique position, and we're looking at what they call Delta Croms, basically coming in and replacing the COVID kind of 19 virus, where it's a new mutation that attacks both the upper respiratory and the lower lung area. And if we have that spike, we could be back into another shutdown, or particularly in Europe and other parts, Asian parts of the world. So we're not post-COVID, we're in a vaccinated era, and we'll have to see how that unfolds. Look at the Canadian supply disruptors. So you guys know and feel a lot of these on the supply chain. You've obviously got the increase in inflation, the labor shortages, delays in delivery times, all the cross-border stuff. We don't make it any easier for you guys to get stuff across to us, or vice versa, or in Mexico, despite the new USMCA or NAFTA 2. Weather unpredictability, we've got droughts, the way we've got the weather patterns going, I think we're going to have a really severe winter here in the northern plains and into Canada on there. The effects of globalization, everybody needing things, how we get it, whether we like Trump or not. What he gave us a warning of is with the tariffs, we realized how little was manufactured in the US and North America. And then obviously the increase in fuel prices, the transportation, how do we move all this stuff around? So you guys are dealing with incredible supply chain disruptors just like we are. This is the Strategic Petroleum Reserve. I mentioned the tapping of it. This is by President Biden's own administrator of the program, Hochstein. He was just on all the Sunday morning news shows this past weekend. And he said, look, if the president didn't mean he's going to release more, which we legally can't do, than the 180 million barrels. He just meant that he's going to get all of it released. So we've got contracts, but not all of it's been released into the market. The Saudis are very upset with us. In fact, a week ago, Saudi Arabia's prime minister and what they call the Davos of the desert. So we have Davos, Switzerland, which y'all know, the big economic summit in the winter of each year. They also have one for energy called the Davos of the desert. And the Israeli or Saudi prince said, look, he was speaking directly to the US about the short-sightedness and the problems with tapping our reserves. And he warned that the continued release of our strategic reserves could have the most dire consequences ever. And when I read that, and the national medias wouldn't cover it very much, that basically sounded to me a lot like the warnings that came before the 1973 Arab oil embargo. So I didn't know if he was trying to communicate that Saudi Arabia and the OPEC folks are threatening us with another oil embargo if we continue the SPR releases, because then we've depleted it and we go into a winter months and we want to try to help Europe, or we need it ourselves. We're not going to have those reserves, and they're not going to be there to add more supply. So it was a very important one. If you look at Davos of the desert and the Saudi Arabia prince commentary, it's a very, very serious, dire speech. So this may make your energy prices double in Canada. So you guys may be very happy about this. All right, the International Monetary Fund. I always look at these metrics. I look at them bigger at a higher level, like globally, and I translate them local, like, GDP at the state level, or GDP from just the United States to look at Canada and Mexico, all three of us combined, because we're so interdependent and interwoven in our economies. Well, the IMF just came out with their new global outlook, and these guys always try to stay, 2% or better in global GDP, but that to them means that's a very low number. They just came out with a 2% estimate. They've only done that 5%, 5 times since the 1970s. And every time they've had, or we've actually had, a 2% range global GDP, we've gone into some of the worst global recessions we've ever experienced. So for the IMF to recognize we're in a really tough spot and to have this forecast, that concerns me quite a bit going into 2023. Am I sounding pretty miserable? Well, we'll get there in a minute. So on the inflation, what metrics should we look at? I mentioned the PPI, the producer flows into the CPI, the flexible CPI here. is one I want you to pay attention to, because this is the real household inflation on slide 14. This is what our households and even your households are experiencing. So go to the St. Louis Fed, look at their FRED system for economic data, where they keep all this, and they've got this back to the 70s. And you can see that in March of 1980, it hit its all-time high of 23% household inflation. When you look at things that reprice every 90 days, rents, food, energy, et cetera. We broke that record in March this year before the SPR releases at 25%. And I think when we come off the SPR releases here, which we have to do this month sometime, or whenever these contracts fill out easily into December, we will go back to the 20+ range versus the more tame 13 to 16% that we've been in because of the SPR releases. So this is the real inflation rate. It's not the one that you do with gymnastics or Zumba in the morning. The Canadian Confidence Index. So we have the University of Michigan here, and we can see both of our consumer confidence has taken a real hit. Our all-time low in the University of Michigan consumer confidence was in June of 1980 at just under 59. We broke that all-time low at 50 in June of this year, again, before the SPR releases. It's recovered from that a little bit, but when that head fake comes off, I think we go back to very, very serious 50-point type of consumer confidence. You guys are obviously seeing it. You're seeing what's happening in the US. You're seeing it when you're inflation. You're thinking it is supply chain disruption. All of our consumers are taking a real hard hit. Yours decreased to 48.5 in October from the low of 50. So that's when you get below 50, you're definitely in recession territory. So your consumer confidence, you know, it is not any better than ours. So if I hadn't made you feel miserable enough, here's the misery index from the Jimmy Carter era that Forbes created. And so again, it was GDP and inflation added together. Now we've added in the S&P 500 and GDP. And until this recent GDP reading that I think was a head fake because of the SPR releases, that we were really at a 29% misery index. And so even if you factor that in and look at the 15 to 20 points off the S&P 500 going to 25 or 30 after today's 75 basis point increase, you'll see that we're all miserable. And you can see we've mapped Europe and the UK. Forbes didn't put one separate for you guys because we always know that Canadian hockey and all of you, you always stay optimistic. If you guys can survive the tough winters and do the hard work of all of the commodities, you guys never get miserable up there. So we appreciate you having a good attitude. You're the sun and attitude of North America. So all of this means we need to pay attention to the yield curve. So we talk about the yield curve inverting, and all that means is that short-term interest rates like the 2-year treasury compared to the long one, 10-year, that their rates are higher than the long-term. And we know from our DCF analysis that if you have to get cash flows 10 years out or sell the property 10 years away, that duration period, long time, has a lot more risk. So that long-term rate should be above the short-term rate. And when it's not, it's telling us how freaked out the market is. And now what we're seeing is the 2-year and 10-year, they're inverted, but they're both rising kind of in about a 40 to 50 basis point differential. So if you look at the 2-year, 10-year, you know, the last 90, 120 days, they've been about 40 to 50 basis points apart. The 2-year higher, but they're moving up equally. The water level is rising. So that's not a good sign at all. That has implications for cap rates, financing, the cost of capital in real estate. And we know our business is very dependent upon that. So here's another one, you know, on the latest threat and the shipping routes with the drought. We have the big Western drought in the US and Lake Powell and Lake Mead down to levels where they don't even have enough water to go over and generate hydroelectricity. In Las Vegas and Phoenix, it's getting that severe a problem. They're almost what they call dead pool. No water can leave anymore. And you guys are seeing as well the Mississippi River. We're seeing the drought along the plain states here, drying up the Mississippi. We can't get barges down. You're seeing the St. Lawrence Seaway as well. And then Europe's got its own droughts and problems. So this is a big issue that's factoring into all the finance issues. Canada's mortgage affordability is also going down like ours, but ours is really bad. I was joking with Ollie before we got on here is, could we have some of your great 4% mortgage rates? And he says, yeah, will you give us a 20 or 30-year duration like we have with our mortgage market here? So we're now at over 7% money. But that's still for a 30-year mortgage. You guys don't have that. So the duration risk is taken out. So that's really the issue, the differential between your 4% money and our 7%. we're going way out in duration, and nobody wants to do that. Look at the market where yours is shorter, so you have less duration risk in your mortgage rates. Your housing supply and demand balance, you're the same, similar situation as us. It's not just an inventory, but it's also an affordability problem. And so we just can't make the numbers work. The cost to build a home, the cost to entitle and develop a site, and then you look at the mortgage rates, the numbers just don't add up. And so the builders have pulled way back. So we both have a similar problem there on housing, and it's really severe on the affordable side, anything under 300,000. Now we need to consider, because we're all commercial real estate folks, what's the impact on commercial real estate values? Excuse me. So here is the commercial property price indices. And so this is Green Street's, which is more institutional quality. But then, as I mentioned earlier, you have CoStar and Real Capitalytics that have ones that are broader. So what we've seen is all property types, whether it's industrial, manufactured housing, self-storage, all the really stellar ones, apartments, they've all peaked. Look at each of those lines, starting with manufactured housing at the top, then industrial, self-storage, apartments. They've all peaked and they're coming down. They've only come down because of one influence, and it's in that center gold box. And that is that our expenses are rising at 2.5 to 3 times what our rent growth is. When you have that impact, look at a multifamily deal, 35–40% expense ratio, growing it at 3 times what the rent growth is of, say, 5 to 10%. You have a negative hit to NOI, and that means about a 15% hit to value right now, 10 to 15. That's what we're seeing so far. But what we haven't seen is this. So this is what by one of our fellow CCIMs. You can email Greg Hout, and he'll send you the Excel little template that he put together. But this is cool. It goes back to what you guys learned. We all learned at CCIMs that our investment management and appraisal pieces of our modules of our courses. And that is, let's say a transaction's dry up, or I want an alternative test of what the cap rate should be based on what my debt and equity components of capital are now costing. So he went back and looked at January of 2021, looked at October of this year. He looked at where the 10-year treasury was, what lenders were willing to do. Your mortgage interest rate would have been in the 3 to 3.5% range a year ago. You're now looking at something close to 6.5 to 7. Banks were more willing to lend aggressively, so 75% loan to values. Forget the 70 over there on the right, try 60%. That's what banks are quoting, if they'll even quote. And when you factor that down a little bit lower there, you can see what happens in your indicated cap rate for the band of investment. And so in January of 2021, we would have seen about a 5.4%. That's how we were justifying and seeing 5% cap rates based on the capital stack. Now fast forward to where we are today, and you're looking at 7.75. The difference between a 5.4, 5.5 cap rate and a 7.75, if you follow it down to the bottom, is about a 25% hit to value. That is what potentially has to play out at the next year if the Federal Reserve and our central banks stay with these higher interest rates. We'll see it trickle through. You put the 10 to 15% from expenses growing faster than rents and hit the NOI. You put 20 to 25% on the cost of capital in a band investment cap rate, and that's how we lose 40% in value. Now, I don't think it'll be that way in industrial or as bad in multifamily, but I do think it's going to be that bad in office and retail in particular. So this is a great tool. I compliment Greg. There's his email, greg@outcre.com. Tell him I bragged about it on the webinar, and he's offered on his LinkedIn post that he'll send it to anybody. This is a very good sensitivity type of tool to have to sit down with your clients, because there's going to be a lot of tough discussions that have to play out between you and your clients and your own portfolios about what's the value and where do you price things. So someone might have an office building on the market and they think it's worth 9x, and you come back and you show them this and you look at where the market is and they're only offering 6 or 7x and they don't understand it. This is one way, very simply, that you can kind of show the client where the cost of capital, inflation, and interest rates are going to cause this kind of a disruption in commercial real estate values. Let's talk about a few of the property types. So here's the Greater Toronto office sector, and I'll talk about office here a little bit. And what you can see is, look at the drop in transactions, but you can see the average price per square foot and cap rate have kind of been moving in opposite directions. And so it doesn't look like this is all caught up to you yet, but I'll show you where it is. So remote office work, I'm going to show a couple slides here. So this is a piece that was just recently done and published by Pulse Survey, where they surveyed, it's the largest survey of remote workers and how they're doing and what they think. And what they found is that bosses got it wrong, that our remote workforce is being very efficient. They're probably more efficient. They're doing more work, and that they don't want to come back to the office full time. And so this is really telling us that we're going to face a different office structure, the different office demand going forward. And so if you look at Canada, here's a good example with Deloitte, where only 1/5 at the bottom left there of Deloitte's workforce, and it's 1,500 people there, have come back to the office. And so what you're seeing is this example on slide 26 that ties into this. For say, for example, the Deloitte example, we have this entity called Castle Systems. They may also be the ones that are providing the technology in Canada for the key card systems that we use to get in and out of our office buildings. And so they track this. They're worse snooping than Microsoft and Facebook. And what they told us is we have not even gotten to 50% that will go back to work. In fact, the only state that has workforce that's going back to work at more than 50% is Texas. Austin, San Antonio, Houston, Dallas are all, if you look at Austin, they're at over 60, almost 65% on that side. So all the way across the US, people are not going back. People do want to go back to some degree. They want to go back for a meeting. They want to go back for a client thing, but they don't want to commute every day. They don't want to do the commute. They don't want to do the dry cleaning bill. There's no restaurants to eat in the office buildings because they all got lost, in the COVID. I was recently in New York, my first trip in 2.5 years. And I have to tell you, my good experience was the new LaGuardia Airport. It's phenomenal. My bad experience was whether I was in downtown at Wall Street or I went up to Manhattan. It was awful. Whether it was the panhandling, the boarded up shops and restaurants, the lack of places to go eat. So the clients I was calling on, our own board of directors meetings, we all met in New Jersey. And you're seeing people say, we'll go to Connecticut, we'll go to New Jersey, because those are the places where people are working from remote. They don't want to go into the city. And I think whether you're in the big cities there in Canada or here in the US, we're really going to see that this is a very disruptive item. And here's the example. This came out of Pension Funds magazine on slide 27. And they looked at all the NACREIF data. And what the pension funds are saying is, we know we've lost 15 to 20% of our value in our big urban high-rise office buildings. And we're not going to go down the path to lose 40 or another 20, 25%. We're going to go ahead and start dumping these assets. And if you look at the bottom there, they estimate that over $500 billion in value could be lost, mainly if you just look at the top 50 office markets, or 25 that are big urban markets: New York, Seattle, Chicago, San Francisco. And look at your big markets in Vancouver and Toronto. This is where as much as 500 billion could be lost in these $6 trillion of assets. I think if there was another quote here I wanted. We don't have it. That's okay. So this is real. And so here for CCIMs, if you are not in dialogue with office clients or entities that have the debt on these office buildings, pension funds, institutional owners, you need to be. It's an opportunity, because they're going to need your skill set at CCIMs to help figure out what is a price they should accept. How bad can it get? Show that band of investment on the cap rate, and then the expenses greater than the rents. So I think we have a real tough time ahead on the office side, and that concerns me. I know what that quote was. I want it. Here it is, the bottom here of slide 24. Look at this from Pulse Survey. We're still in the middle of the biggest workplace paradigm shift we're apt to see in our lifetimes, and leaders are feeling the pressures. So this is not a little blip. This is a systemic watershed event, as much as what we experienced in the 70s with the oil shock, and as much as after World War II when we converted from wartime economies to peacetime economies. So let's talk about retail. I'm only going to hit you with one retail statistic, and this is a new one that shocked me, but I think we really need to think about it when we look at the economy, recession, consumer confidence, and what's going to play out here in the holidays and retail sales. This is produced by a company called Coresight. They do incredible primary research on retail, and they recently started looking at the carts in our e-commerce. So what are we doing? Are we closing on these deals? Are we purchasing? And so they went back and they looked at what is the historic rate that we cancel orders in our cart when we go online and do e-commerce. And that ratio up until about the summer of this year was about 10 to 15%. So think about the effort we do on online commerce, e-commerce. We find the good, we get a coupon, we put our credit card stuff in, we pick the color, all those kind of things, or the size, we get it into the cart and we're ready to push. That's 20 to 30 minutes of time. And what course I found is it's no longer that 90% of us are closing and purchasing that item. They found in the last 90 days that consumers are canceling those cart orders at the rate of 75%. And that's telling us that things really might be difficult this holiday season, that e-commerce isn't even that good. And what it means for supply chain and logistics and retailers, most retailers are only looking at the metrics that are the clicks before you get to the cart. So all they're seeing is all these people online looking, getting things into the cart, and they're failing to look at the purchase rate. And so they're loading up warehouses, they're loading up manufacturing. And by the time they figure out after the holiday season that 75% of us cancel those orders and they back up in the warehouse, we have a real problem. So that's why I bring this one into focus. It brings the retail and the logistics warehouse together. It's probably the most important statistic that I've seen in retail in probably a couple of 3 years. Here's your retail sector. Again, you see, things are all, kind of trending down. The physical store is less relevant, so not too different from the US. But here's one I want to spend time with because we spend a lot of time. It shows you the value of logistics and supply chain and entities like Site to Do Business and Esri. So when I was at Colliers, I developed, as their chief economist, I developed this concept as we were expanding the Panama Canal of the Golden Triangle. And when you look at the US and the value of the markets in the real estate in the US, it's basically from the Fourth Coast, where we join you guys, Great Lakes, down to Texas, and then down through the Southeast and Mid-Atlantic. And in that Golden Triangle, that's where over 70% of our US population resides. It's where over half our GDP is produced, and it's where over 80% of all new manufacturing, onshoring, and logistics expansion is occurring. To test that, which I had done, but I didn't have the Site to Do Business and Esri data, back in 2010 to 14. We put this together, Beverly and Kaylin on our team. And what we did is we mapped all the big FedEx e-commerce facilities. We mapped all the Amazons, and then what looks like the wallpaper, the blue, that's all the Walmart stores. Look at where the FedEx, the Amazon, and the Walmart supply chain in stores and retail and warehouses are. They're basically east of the Mississippi Valley region. They're from that Great Lakes straight down. And what this means is our supply chain with Canada is going to be reinvented from LA and the West Coast to the Chicago to more north-south. And when you visualize this and look at FedEx, Amazon, and Walmart, this tells you as well with the railroad and other things that this is where logistics is. It connects with you guys in Canada. So Altus has some things on your industrial trends, and you can see your industrial activity is strong. You can see it's the strongest in the blue among retail and office. So no surprise to you on that. If you look at your industrial sector, again, very strong, very healthy, transactions strong. We know it's all about reinventing our supply chain, but the supply chain in these warehouses, industrial, that you guys are developing, think of how it touches and aligns with that Fourth Coast and the Golden Triangle and all the way down to a new north-south supply chain in the US versus a horizontal from West Coast to Chicago. So here's where it all comes together that's incredibly important for you guys is the railroads. So these colored lines represent our Class 1 railroads between our two countries. The red line is Canadian Pacific. As you know, your two big ones are Canadian Pacific and Canadian National. They dueled it out over acquiring Kansas City Southern. Canadian National had it first, and Canadian Pacific succeeded in taking it away. And that red line, which connects Canadian Pacific down to the brown line of Kansas City Southern that goes down into Mexico and all of its ports, it's the one and only North American intermodal rail in the country, in North America. So it's incredibly important. You can see Canadian Pacific from Port Rupert and Vancouver, all the way down into the Midwest and all the way down into the US. Look at the other rail lines. So if you look at the dark blue Norfolk Southern, CSX, the light blue Norfolk Southern, whether you look at BNSF, the black line, only the gray Union Pacific really hugs the West Coast and really doesn't really move north-south. And so when you look at that encompassing you guys, the Great Lakes, the Midwest region, you can see how important the rail is to supply chain and industrial. And when you get that, as well as the kind of the golden triangle where you need to hug and intersect is pretty important. This next slide on slide 34 is from a paper that Beverly and our Red Shoe team that we did for a client. We had the state of Alabama trying to develop a new inland port to support the port of Mobile down in the Gulf. And we had a client trying to do that. So they kind of wanted to know, where are all the ports? Where's the inland waterways? Where does all this connect? So the blue dots on the bottom represent all of our ports along the Gulf and the Atlantic there. And the yellow represent our inland waterways that are all jammed up because they don't have enough water flowing down them. But they were very important during COVID, because where we had supply chain backup, we could move things through the inland waterways. But if you look at New Orleans, the Atlanta Federal Reserve District has more ports in its district than any of the 12 districts. San Francisco is next. So from New Orleans all the way around to Savannah and Brunswick, across Florida up into Georgia, those are 22 ports in the Atlanta Federal Reserve District. Those 22 ports move twice the supply chain in containers as an LA or Long Beach. Just think about that. So we didn't hear anything about it. And those 22 ports didn't have even 10 ships backed up through all of COVID. They've got redundancy, whether we have hurricanes or not hurricanes. You can bring things from the Panama Canal up into the Gulf ports like Freeport and Mobile. You can bring things into the East Coast from the Suez Canal, directly from Europe and whatnot. And so when you wonder why the Federal Reserve didn't get supply chain risk, it's two districts that have all the ports, primarily the Atlanta Fed and San Francisco Fed. They do zero research and reports on supply chain and ports and logistics. That's why they didn't get it. That's why they miss supply chain inflation. And just one more failing in the Federal Reserve System here in the States. So this explains all of this and why these ports are so important. The other thing that's happening is we're really seeing the validation of this theory that I propagated, really a few years ago, that we would see a rebuilding of our supply chain even before COVID to more of a north-south one, because all of our logistics infrastructure from the Great Lakes down to the Gulf and the Southeast ports, the rail, the interstate, the ports, all of those are in our district. So we're seeing the remaking, and what we just saw is that Savannah is now had a backup of over 40 ships, and the new 30 ships that weren't there before all used to call on the ports of LA and Long Beach. We've also seen what's happened in LA, Long Beach. They went from 109 ships backed up last holidays to last week, they had 4. Think of that, from over 100 to only 4 ships that need to be unloaded. They're all moving through the Gulf, the Panama Canal, and they're moving through the Suez Canal into the East Coast ports. The other thing that's happened that's important for you, LA and Long Beach are no longer the busiest ports in North America. So New York overtook LA and Long Beach as the busiest container port in North America, followed by Savannah, and then you've got LA and Long Beach. Savannah now handles as many, over 6.5 million containers, is what LA and Long Beach used to handle 3 to 5 years ago on an annual basis, each of them handling that number. So the whole thing is shifted, and it's near our population. It's near all of our logistics infrastructure. It really is kind of a big deal. So when I study all the supply chain stuff, and these entities that I give you here on slide 37 are ones that also cover Canada. So our Corps of Engineers, Journal of Commerce is a global one. The American Association of Railroads, all the rail activity from Canada all the way down through the US into Mexico, to cover all of North America. These are those resources. So here's all my secret sauce that I'll share with you. And many of these are either free or relatively inexpensive, $100 a year subscriptions. So here's my secret sauce. All right. This slide I want to put in here, not to emphasize Amazon's overbuilding. We know they overbuilt. The initial thoughts were it was maybe 10 million square feet of additional warehouse. That number turned out to be 50 million, but we're working through it. It was mainly in big markets like Dallas and Atlanta, Nashville. But when I was trying to figure out this impact of Amazon overbuilding, I stumbled onto a resource, and I'll share it with you because if you want to study or know anything about Amazon, here's the go-to primary resource, because Amazon gives them all of their data. And it's at the top there, the first red arrow, MWPVL. So they are the exclusive private entity that gets all the Amazon data, the stores, and relocations, and statistics. And in the lower left corner, there is a link to MMPVL, where this back door is where they post all of their presentations on this data. It's free. you can find it out there. I couldn't believe it. So one of them I posted here is the one that they did on online grocery and what's happening and the growth there and what it means for logistics and supply chain. We include this in our logistics word course that we do. But if you need to spy or know what's going on with Amazon, this is the most valuable resource that I found, just like that core site on the cart data, what people are doing in the cart. These are two of probably the most valuable new metrics. You won't find any of them in the FOMC data that they look at. You won't find them in the realtors models that they look at commercial real estate. I'm giving you stuff that you're not going to find out there. Economy.com, Mark Stanley, Moody's, none of them have these primary windshield indicators that they're putting into their forecast models. So ESG, I'm going to pivot here and do ESG scoring and whatnot. We're going to need to have ESG scoring at the property level. We already have it on every public company. And there are two entities that have been doing it. They're called proxy advisors, ISS and Glass Lewis. They were largely responsible for destroying the REIT that I was a director on called Monmouth. And we were primarily one of the big landlords for FedEx. And what they do and come up with scoring, particularly on industrial, they say you're awful, you get a 0 score, you cut down trees, you pave over the land, and you bring in diesel burning trucks, you get a 0 score. Nothing, it couldn't be anything further from the truth. So I gave them our annual barbecue sauce award. And again, remember, that's my polite way of calling BS on something. The backside label of our barbecue sauce says, no calories, cures cancer, prevents COVID. The front side of the label there that Beverly designed says, we're the red shoe economics and economists, and we're calling barbecue sauce on all that. I will tell you the entity that has figured out how to do ESG scoring at the property level, and it's a good relationship with our industry, with the CCIM and the realtors, and it's IREM. And so the IREM is on the right there that actually gets it right. ESG investing, I want to call something attention to you guys that you're not taking advantage of. It's called the PACE program. It's called Property Assessed Clean Energy. And it allows you to take an empty or outdated or energy inefficient building, and you can get capital through the taxing authority, the tax assessing authority, to redo that building and upgrade it under a clean energy auspices. And because and then the way they recover the payment is through your tax assessment. So since tax assessment, at least here in the US, is senior to mortgage debt, you don't have to talk to your lender. You can get it done. They underwrite it very quickly to make sure that the NOI is equal or accretive to the clean energy program, and it's transferable. And it is better than a 1031 exchange when you look at, how do I take an empty or an old building and I don't know what to do with it? Where do I get the capital when the bank won't give me financing right now in this inflationary environment? Where do I get it? Where can I get it done? It's through this PACE program. Canada has not adopted it. So I really encourage you to do that. So I'll wrap up here so we can take a question or two. This is my son, Luke, a 12-year-old. I have 3 adopted special needs kids. Luke's my youngest at 12, loves basketball. Can't believe I got this shot of him making a basketball into the net. And then I've been corrupting him, teaching him pool. And so what Luke wanted me to tell you today was that you have a great shot lined up to succeed in this recession. You're in the right geography with manufacturing, ag, logistics, the Fourth Coast, the CP Kansas City Southern merger. You're probably going to see Canadian National be forced to have to come down and acquire either Norfolk Southern or CSX to compete with the merger that Kansas City, Canadian Pacific did with Kansas City Southern. You have great logistics infrastructure. You guys know that. Port Rupert, you don't have to pay harbor maintenance taxes on the containers that come in. You kick the rear end of Seattle and Portland and Tacoma because of your port. You can make long 200 rail cars and come down through Vancouver and down in the Midwest US. You're our Fourth Coast. We forget about that here. You guys get it. Most of us don't get how important that is in the St. Lawrence Seaway. You have great fundamentals. As bad as things have been in terms of correcting, you still have positive absorption and rent growth and good value creation. So you're really lined up there. I'll close. In Chicago, the Institute released our 9th paper that we've done in 5 years for the Institute. It was on disaster preparation, and it's not just about hurricanes and tornadoes and wildfires. It's about all the other kinds of disasters that happen and how as communities we have to prepare for them. One of the examples we used was Jackson, Mississippi. The thing they didn't prepare for was the water treatment plant being flooded, and they'd known this for 10 years and it was outdated. And it has really hit the economy in their state capital very hard. So there's where this is. It's on ccim.com/insights. This is a little graphic that kind of shows some of the disasters and the numbers. And so I'll wrap up here. Yogi Berra and Jimmy Buffett are my two favorite economists. So I'll give you Jimmy Buffett because we're really in that period of time where changes in latitudes and attitudes, we don't know which way to go. And we hope we don't end on volcano or eclipso. So on the left there, Jimmy Buffett had a real good album cover for an advice for us. I can't change the direction of the wind. Substitute that inflation or the Fed. I can't change the direction of the Fed or interest rates inflation, but I can adjust my sails to reach my destination. So think about that PACE program and a funding program. Think about all the things that you guys have going for you in Canada. Hey, there's going to be times where we're not going to be able to figure it out. It's going to take longer. It's going to be stressful. Breathe in, breathe out, and we still got to move on. I love the other one down there in the lower right. It says, without geography, you're nowhere. That's a good classic. But my favorite is Yogi Berra gets the award. You can observe a lot by just watching. Right now, it's so important we step back. We don't just bounce off of these individual metrics that come out. We try to triangulate and correct them or connect them like Creppy does. And we're going to have to observe a lot here and not have immediate answers. So anything we can do to help you at Red Shoe or anything the Institute's leadership has been great. They've had us in this role. I just finished 5 years in this role. We have a lot of good things that the leadership does. You're a very important part. You don't hear it often from America, but I love Canada. I spent a lot of time there with Colliers, so we really appreciate that. And here's a little bit on our company there. So I will stop there, Ollie, and see if we have time for a question or two.
Perfect. Thank you very much, Casey. That was a great informative session. We have time for just one question and from the audience. And that question is with the increasing demand from working from home, how are office property owners coping with higher vacancies? And as you mentioned, major landlords are starting to offload some of these office assets. Do you see some opportunity where a mixed use product could be coming to fruition?
Yeah, so it's interesting, and this could play out very well for you guys. So it's adaptive reuse. So we're seeing major office buildings in urban centers completely convert from office to something else. St. Louis just had a big building that they just basically was 100% loss in value that they're going to try to convert to housing. We just had a big one, a former bank building in downtown Atlanta that basically they almost gave it away and they're going to convert it to affordable housing and housing to shelter people. So think about that. We could have housing and housing for the homeless in our CBD if we don't also figure out how to make all that work, and the other things that come with that, we could be in trouble. The second one, though, that really blew my mind away, it's an example in Chicago. The client won't allow me to identify the building yet, but it's aquaponics. So this client had over half the building empty. They couldn't get tenants in the Chicago market. So they went and they cleared out the half floors and they made them into aquaponics. So no TIs. The plumbing in the basic restrooms was enough to provide all the water they needed to grow tilapia fish in the interior. They use the fish poop water that they pump into racks that they put in staged areas for the lighting. And then they have robots moving along the rack, sensing when the fruit or the tomato or the lettuce is ripe. It sends it a pulse and it drops into a basket in its arms, and it takes it down to the elevator and they send it down for harvesting. And because it's locally sourced and organic, it gets a premium on the grocery stuff. And so when they looked at the NOI numbers, they had me go through them. The NOI per square foot for aquaponics in an office building, not having to redo TIs and carpet and all that type stuff, is greater than it was even 10 years ago as an office building. So adaptive reuse is going to be the big answer. I think what's happening is we're going to see the institutional money panic. They're going to want to dump this stuff. They'll take 20% losses. They're not ready to take 40 or 50. And so folks that can sit there and have some imagination about what to do. But I think the urban office stuff is in real serious shape. The suburban, though, not that case. People want small chunks, 5,000 up to maybe 10,000 square feet, close to their workforce, no commuting. So I'm very bullish on suburban and I'm very bearish on the urban. go grow strawberries and lettuce in the vacant office space and make money.
Awesome. That is great. Thank you very much. Casey, thanks again for sharing your expertise with us today on this webinar. And thank you everyone joining us and attending. As a reminder, the recording and the accompanying presentation will be emailed to all registered attendees. And if you're not already a CCIM Institute member or course participant, please take a moment to sign up for our e-newsletter at ccim.com to stay informed about complimentary webinars like this one, as well as other professional development opportunities. Thanks again, Casey. Thanks again, everyone. Have yourselves a great day. Till next time. Bye-bye.
Thank you. All right. Bye.